Hello and welcome to this session. This is Professor Farhat. In this session we would look at what is a debt service fund, DSF, and we would look at a comprehensive example. In the prior session we'd look at capital project funds. If you don't know how capital project funds work, by all means go back and view the prior recording, capital project fund. So what is the debt service fund? The debt service fund accounts for and report financial resources. Okay, once again, financial resources. Although it sounds like debt service fund, it sounds as if we are keeping track of the debt, but that's not what we are doing. We are going to keep track of financial resources, which is usually cash and near cash asset, for that are restricted, committed, or assigned for expenditure for principal and interest on all general long-term debt. So notice, in the debt service fund, we don't account for liabilities, no long-term liabilities. Okay, although it sounds like debt service fund, we must have the debt there. The debt is not there. Okay, so it will account for the resources. What are the resources? Things that we're going to pay off the debt with, things that's going to be restricted for principal and interest, but not the debt itself. Okay, so that's the first thing you want to make sure you understand. This does not include debt issued for and serviced by the enterprise or the internal service fund or some trust fund, because remember, those funds, the enterprise and the internal and the trust fund, are really separate, in other words, independent from the other governmental funds. Debt service funds accounted for on the modified accrual basis. There you go. So which accounting method do we use? The modified accrual basis. No surprise here. No surprise here. Okay. Exception, we have a couple exceptions. Exception, interest and principal are not considered current liabilities. So when we don't accrue interest, okay, this is what we're saying here, until the period in which they must be paid. And we talked about this when we looked at expenditure. When you look at expenditure, we said expenditure are very similar to accrual, except, and we looked at 7 exception. The interest and the principal was one of those exceptions. So if you don't understand the statement, go back and view expenses versus expenditure recording. But here we go. Interest revenue on the bonds held as an investment is accrued. So sometimes what's going to happen, the debt service fund might have cash that they invest in bonds. So they buy investment in bonds. Now the bond pays interest. The bond pays interest. Those are investments. Those are not debt. So what they did, they bought a bond. What do bond pays? Bond pays interest. So any interest accrued, it can be any interest expected to be received can be accrued. So this is basically an exception. So we can accrue interest revenue, but we cannot accrue interest expense. Let me write it up here. Maybe it will be easier for you. Accrue interest revenue, okay. Accrue interest expense, not okay. Not okay. Okay, so you cannot accrue the interest expenditure. Okay, where the resources come for the debt service revenue? So because it accounts for financial resources. So where do the resources from? Well, they come from transfer from general fund. Okay, so the general fund transfer money to the debt service fund, and the debt service fund pay off the debt. That's one source. Special taxes restricted for the payment of debt. Well, to construct a new high school, a school district may dictate a portion of the property taxes to the repayment of the high school. So basically, we have a special tax that's designed to do what? To pay off the debt for the construction of the new high school. So it's a special tax. Or special assessment, basically like special tax, charges to identifiable group of residents who would receive a disproportionate share of the benefit of a project for which long-term debt was issued. That's another thing. So we did, we incur expenditure for a long-term project, and we incur debt, but that project is for residents that are receiving this appropriate share of benefit. Like, we build them sidewalks, but we're not, they're outside the jurisdiction of the overall city, then they pay special taxes. Those are the sources of the money. Okay, so when do we establish a fund? GAAP required the debt service fund be established when it's legally required or the financial resources are being accumulated for principal and interest payment maturing in future years. So it's either legally required or we want to keep track of that. GASB recommend a single debt service fund for all debt serviced by taxes, by property taxes. Government hold number of fund to a minimum. So you can have more than one fund. You can have one fund that include all the debt. It's up to you. But government try to keep them at minimum. Do we need a budget? Well, budget are not common for the debt service fund, but they can be, okay? If debt service fund receive funds from other funds, so if the general fund is giving you the funds, if it's giving you the money, then the other fund maintain control. So we don't need to have a budget. Exception, of course, there's always an exception, if resources are derived from special taxes or assessment. So remember, we can get money from special taxes or assessment, then appropriation budget enhances control. So under those circumstances, it's better to have a budget because you are raising money specifically for that project. At the end of the day, decision of budgetary accounts is usually decided legislatively. And we're going to work an example, and we'll assume that we're going to have a budget in that example. So we'll work a problem with an example. Actually, let's go ahead and work the problem now. So this is a comprehensive problem. And through this comprehensive problem, we're going to go through a series of journal entries that's going to help us understand how the debt service fund is established, what are their sources of revenues, and how do we do accounting for. Okay, so let's start with this example. On January 2018, Culver City established a debt service fund to account for a serial issue of $100 million 6% bond sold at a premium of $0.2 million. So basically, what is a serial bond? Well, let's talk about a serial bond. Serial bonds are repaid in installments. So basically, you have, when a company or when a government wants to raise money, they can borrow, for example, $100 million today and pay it all at once 10 years from now. 10 years from now, all at once, they repay the principal. That's one way to repay the principal. Or they can borrow the money now and pay the principal in pieces. So this way, they don't have to come up with the full amount of money all at once. So this is what a serial bond is. Okay? So when you pay the principal all at once, it's called term bond, which mature on a single specified date. So the first installment may be delayed for several years after the serial bond has been issued. So we don't pay the bond immediately. If it's serial bond, we can, but we don't have to. And uniform payment may not be required. So what we do is we pay a little bit every year. Okay, so that's up to us how we want to arrange the payment. But serial bond means you are paying back the principal in pieces. So the amount of principal repaid with each installment, although established in advance, may vary from year to year. Serial bond are, in essence, nothing more than a collection of term bond, each of which mature at a different date. That's all what it is. That's all what a serial bond is. So we have serial bond and term bond. That's all. Okay? Principal is to be repaid evenly over a period of 20 years. So what's going to happen? So they borrowed 100 million. And that's going to be paid over 20 years. So every year we're going to pay back 5 million in principal. Interest is payable semi-annually beginning June 30th, 2018. Of the bond proceeds, 2 million is to be retained by the debt service fund. So after we issue the bond, 2 million is to be retained by the debt service fund. So we're going to send 2 million as a reserve for payment of interest and principal. So what they want us to do, they want us to send 2 million to the debt service fund. The debt is to be repaid from a voter-approved addition to the property taxes plus earnings from debt service fund investment. So what's going to happen? So also we're going to raise taxes. So we're going to have taxes in this example. Taxes, which is it's equal to revenues for the fund. Plus, we're going to have investments. So any money that's sitting in the fund, we're going to invest it and it's going to earn some revenue. Any revenue shortage to be made up by a general fund appropriation. And any money that's needed, any shortage, the general fund is going to advance the money. Although the revenue generated by the property tax are expected to increase over time, the city estimate in 2018 we will collect 8 million, far less than the required interest and principal payment. Okay? Assume expected investment revenue to be 60,000. Here's what's going to happen. Now we're going to process the budgetary journal entries. Okay? Let's start with assume expected investment revenue is 60,000. What do we do? Well, we're going to debit. So now we're going to start to put down the budgetary account. So we estimate to have $60,000 in investment revenue. Well, we could put estimated revenue from investment. We're going to have debits and we're going to have credits. Remember, those are budgetary account, so the revenue is a debit. So that's the revenue. So we're done with the revenue. Okay. We're estimating $8 million in property taxes. In taxes. Is it property tax? Yeah, property taxes. Well, let's go ahead. Estimated revenue. Property taxes. $8 million. Okay. What else? Of the bond proceeds, it reads here, of the bond proceeds, $2 million of the bond proceeds, $2 million to be kept, $2 million to be retained by the debt service fund as a reserve for payment. So we're going to transfer $2 million. In addition to the $2 million, if you remember at the beginning of the problem, it says also $0.2 million was premium. Remember, any premium, if you remember from the capital project fund session, any premium when we issue a bond, any premium is transferred to the debt service fund. So we estimate also to have the $2 million plus the premium to be transferred to the debt service fund. So let me get my pen. So estimated transferred in $2,200,000. Why $2,200,000? Well, we need to keep $2 million. That's the requirement. They want us to transfer $2 million and keep it there as a reserve, as basically a protection. And the $200,000 is the premium on the bond, which we are required to transfer to the debt service fund. Remember, any premium is transferred. Now let's take a look at our appropriation. We're going to have to pay the principal, so we're going to have appropriation. The principal amount, and how much do we have to pay every year in principal? $5 million. Those are the expenditure, but those are now we are crediting them because those are budgetary account. Also, we're going to have to pay interest, appropriation dash interest, and the interest is $6 million because it's 100 million times 6%. The deal is 100 million. It's a 6% bond. Okay. What else are we missing? Okay. For the estimated transferred in, we're going to increase the fund balance. We're going to credit fund balance. The fund balance is going to be increased by this amount, $2,200,000. Now, whatever we need, remember, whatever we need, we're going to get from the, this is estimated transferring capital project fund. This is the 2 million for. Okay, so whatever we need, we said, what are we going to do? We're gonna get it from the transfer from the general fund. Therefore, we're missing here. These are the credit 13.2 million, and here we have 10,260,000. So we're missing 2.94 million. So 2.94 million, and this is going to be estimated transfer in from the general fund. It should be now 13.2 million debits and credits, and those are the budgetary entries. So here what we did is we set up the budgetary entries. Let's see. Hopefully we did that right. Let's see. We'll go next. Okay. And this is the budgetary entry. So we accounted for the investment. We accounted for the revenue from the property taxes, investment, property taxes, the capital project transferred in, the general fund, this is a plug, interest, principal, and the 2.2 fund balance. So those are the budgetary account. Okay, the bonds are issued and the proceeds are placed in the capital project fund. So remember, when the bond is issued, what we do is we debit cash. Hopefully you remember how to do this. We debit cash, 2,200,000. This is what we do. I'm sorry, not 2,200,000. We debit cash 1,200,000. We credit financing sources, other financing sources, bond proceeds, other financing sources, bond proceeds, 100 million, and other financing sources, premium, 200,000. This is when we initially issued the bond. This is in the capital project fund. Now the bonds are issued and the proceeds are placed in the capital project fund. So this is how we do it. The premium of 200,000 and the 2 million to be held in reserve are transferred from the capital project fund. So what's going to happen now? We are going to debit cash for 2,200,000 and debit other finance source. Okay, so this is the transferred in. To transferred in, to do what? To transfer 2 million from the 100 million and to transfer this 200,000. Okay, so basically this is to transfer the 2,200,000. Now we transfer the 2 million to 2 million and we transfer the 2 million. We debited cash and we credited other financing sources, which is a reciprocal transfer from the capital project fund. So we took the money out of this fund, put it into this fund. Now obviously the capital project fund, they will debit other finances uses and they debit cash. So the capital project fund, although we're not doing accounting for it, they will debit other financing uses, to debt service fund, 2,200,000, and they will credit cash 2,200,000. Okay, but we're not concerned with that. So this is now the debt service fund. They already have in that amount, in that account, 2.2 million. Notice we're starting to, this is the first time we are putting money in the debt service fund. Okay, because the first entry was a budgetary entry. The bond was issued in the capital project fund. Now the debt service fund has $2.2 million. The city purchased as an investment 1 million long-term U.S. Treasury note acquired in the secondary market. So they bought a long-term note. The note pay interest at a rate of 6%, 3% each semi-annual period, and mature in 7 years. They are purchased at $894,369, a price that provide an effective yield of 8%. So we bought them at a discount. So what we do is we debit investment. Basically what we're going to do, we bought an investment. We're going to debit investment, whatever we paid for it, $894,369. We're going to credit cash, and this investment is going to generate some investment revenue for us. Okay, so we're going to debit investment in notes, which is an asset. So this is an asset. Basically we took some of the cash, not all of it, and we bought an investment. Why? Because this investment is going to do what? It's going to earn us some money. Okay, what's the earning? Well, remember, it's a $1 million face value, and it's going to earn us 3%. So every 6 months, we're going to earn $30,000 in cash as interest. Okay? So recognizing investment earning. During the year, the city received 2 semi-annual interest payment, $30,000, which is the 1 million times the face value times the 6%. Meanwhile, the fair value of the note increased by $57.75 in the first period and $6,006 in the second period. Also, the investment went up in value. In absence of the changes in prevailing interest, the fair value of the note can be expected to increase each period by the amount by which the discount would otherwise be amortized. So those are the amount that are amortized for the note. Now, if you don't understand how this works, go to my intermediate accounting. This is where I work amortizing investment and bonds, or in debt. But this is, we're going to assume that you know how it works. And that way, the fair value of the note at maturity will equal to the face value. So as we amortize the discount amount, it will go back to the, after 7 years, it will go back to the face value. So here's what's going to happen. We're going to debit cash, $30,000. We're going to debit the investment in the note, which is the amount that, the change of value, which is the amount of the discount amortized because we bought this bond at a discount, then we're going to credit investment revenue. Okay? Now remember, investment revenue, technically, it's a revenue account because this is investment revenue. Basically, it's a revenue. It's an income statement account. Also, this is for the first period. In the second period, we received cash of $30,000. Investment went up. We debit investment $6,006, which is the amount of the discount. Then we credit investment revenue $36,006. So those two account amount to, let me just look at just do a real quick calculation, amount to $71,781. This is revenue. This is investment revenue. We estimated it to be, $60,000. It means we made more revenue than we thought we will. Okay? Now, recognizing tax revenue. Remember, this project, it says we're gonna collect taxes of $8 million during the year. The city collects $7.5 million of the $8 million in dedicated property taxes due during the period. So what we did is we only collected 7.5. We expect to collect the remaining balance in 60 days. Good news. So we're gonna debit cash immediately 7.5. We're gonna credit. We're going to debit some receivable for 0.5, and we're going to credit revenue, property tax revenue, for 8. Okay, so here we're going to be able to recognize the whole 8 million in revenue. Why? Because we receive immediately 7.5, and the remainder, it's going to be collected within 60 days. Now remember, if it's not collected within 60 days, we cannot account for it as revenue, okay? Because of 60 days, therefore we have a receivable and we have now a revenue of 8 million. Okay? So remember, this is the same concept as we did in the general fund. In the general fund, when do we recognize the revenue? When we receive it, and 60 days after year end. Okay, so this is the same concept. So nothing should be a surprise here. So property taxes are recognized as revenue as the same basis as in the general fund or other special revenue fund, which is the same thing. Taxes restricted to a specific purpose may be recorded initially in the general fund, especially if, as in this situation, they are not part of a larger tax levy. Okay? However, it's generally preferable that they are reported directly in the fund in which they are dedicated. And this is what we did here. We bring them to the fund immediately. So that's another source of revenue for the project. Now we're going to record the transfer from the general fund. Remember, we said any shortage, we're going to transfer from the general fund, and the amount of we're going to be transferring is $2,940,000. Therefore, we're going to debit cash, $2,940,000. Credit, what do we credit? Other financing source from general fund, $2,940,000. Okay, so basically this is the entry. We're going to debit cash, credit another financing source, which is a non-reciprocal transfer from the general fund. So this is the accounting for the transfer. Now the city made the first payment of interest. Remember, the first payment of interest is made on June 30th. This is the deal. The first payment is made at that point. Now what do we need to do? Well, we need to record an expenditure. Okay, we need to record an expenditure. So we're going to debit an expenditure for $3 million. Why $3 million? It's 100 million times 6% times 1/2. We pay interest 1/2. And we credit matured bond interest payable. Now, once we actually cut the check to pay it, we're going to debit matured interest payable, which is the liability, and credit cash. Now, we have to understand that in some textbook, so many government use a bank or another physical agent to distribute the payment of interest and principal to bondholders. This is in some, maybe the book that you are using, they use this method. If they do so, then any cash transfer to the physical agent should be reported as an asset, cash with physical agent. Simply put, what's going to happen, before you make the payment, so what you do is you transfer cash. So for example, let's assume you want to pay this $300,000. First, what you do is you debit an account called cash with physical agent, credit cash, the $3 million. So that's what you do first. First, you transfer the cash to the physical agent. Then you debit the expenditure. Okay, you debit the expenditure. Then when you pay the cash, what you do, now what you are doing, you debit the payable, then you credit cash with physical agent. So what you do is you debit this account, cash with physical agent. if the government uses a physical agent to pay off their liabilities. In this situation, we don't. And the reason I did this, just in case in your textbook you have it, therefore you know what it is. Okay, so this is the first interest payment. Now we're going to look at the second payment. So although the second payment of interest and the first payment of principal are due on December 31st, the city does not actually mail the check till January 2nd. Nevertheless, the expenditure and related obligation must be recognized when the payments are due. So let's go ahead and look at the second payment. The second payment is pretty straightforward. We're going to also pay interest of $3 million. So here's the entry. Once again, remember, so we debit expenditure, credit payable. Now also, if you remember, we said we're going to make the principal payment equally. So we're going to have 100 million divided by 20. So every year we're going to pay 5 million in principal. Therefore, we're going to debit expenditure 5 million, credit mature bonds payable 5 million to start to pay off part of the principal. Now remember, in 2 days we're going to debit the payable and credit cash. So in 2 days, what's going to happen is we're going to debit the payable. This will be debited. This will be debited, and we credit cash. Okay, we debit this amount here and we credit cash. So hopefully you know this. Now once that's it, we did everything. So remember, we have to close the accounts at year end, because this is not like the capital project fund. The debt service fund, you have to close the account. So what do you have to do? You have to close all the budgetary accounts. So let me highlight the budgetary account first. So this was about, I'll highlight them in yellow. So you're going to have to close the budgetary account, appropriation interest, appropriation principal, estimated investment revenue, estimated property revenue, estimated transferred in, estimated general fund. What else? What else? Did I miss anything? Okay. Now I need to close, those are the budgetary accounts. Then I need to close all the temporary accounts. So I'm going to just highlight them in this color. This is not good. So I'm going to have to just check them, all the temporary account. What are the temporary account? Accounts that goes usually on the income statement, which is this account here, other financing sources, property tax revenue, investment revenue, okay, expenditure, and this is a plug. So whatever I need, I debit the plug. And the reason I had the plug of 11,781, because remember, I estimated my investment revenue to be 60,000. It ended up to be 781,781. So I have 11,781 in investment revenue, and this is why it increased my fund balance. Simply put, if I earned the investment of 60,000, if I earned exactly of 60,000, let me do this in red. So if I earned investment of $60,000, then there will be no need for this. Okay, then everything will be as expected. The only thing that was different than what I budgeted is my investment revenue was 11,781 higher, which in turn increased my debt service fund by 11,781. I will take it. I can use every penny to do what? To increase my fund so I can pay off my debt. Now let's take a look at the income statement, or the statement of revenues and expenditure. For the debt service fund, we're going to have revenue, property taxes, and investment revenue. So total revenue of $8,071,000. Expenditure were for the interest and for the principal. Total expenditure $11 million. We have deficiency of revenues over expenditure, negative $2,928,000. We have a transfer from the general fund. We have a transfer from the capital project fund. Other financing sources, $5,140,000. Now what's going to happen? This will cover this, and we'll have a remaining excess of revenues and other financing sources over expenditure of $2,211,781. The beginning fund balance is 0. The ending fund balance is $2,211,781. Now next year, this will be the beginning balance here. Okay, I'm sorry, this will be the beginning balance here. Okay, so notice this is basically the income statement, and this is the rollover equity, basically, or retained earning if you think about it. Okay, so this is our income statement. The other thing we want to look at is, let's take a look at the balance sheet. What do we have in assets? We have cash. And again, if you don't know where this number came from, use a T account. Okay, and we started with cash, 2,200,000. Remember when we did this transfer, then we credited, we debited cash, we debited, we credited, we debited, we credited. At the end, you should have 8,805,631. You can confirm that yourself. We have property taxes receivable of $500,000 because we still have waiting to get the $500,000. Investment in note 906,150. We bought it at lower, but it went up in value. We have matured interest payable. We're going to pay on January 2nd, and the bond of the principal amount of 500,000, and this number is coming from the previous statement. Okay. So this is the balance sheet for the debt service fund. So hopefully you are getting familiar, a little bit more familiar, because we did one example with the capital project fund, and this example is the debt service fund. So hopefully you are getting better at this. Remember, in the capital project fund, we did not have the closing, and the reason why we did not have the closing, because the project that we worked with did not end. So if the project doesn't end, you don't close the accounts. You don't close the accounts until the project has ended. If you have any questions, any comments, by all means, email me or see me in class. Study hard, and good luck. The next thing I'm going to do is start to work maybe on the enterprise fund.